Him's House, episode 46. My name is Jonathan Stern. I'm here as always with Patrick Lester, who goes by the name Bayside in the Him's House Discord. We're joined today by Rob Leclerc, founder of AgFunder, recently named one of the top 100 VCs in America by Time Magazine. AgFunder is a deep tech venture capital firm investing in early stage startups that are solving real world problems in food, agriculture, and the planet. Rob is a private markets guy, but is fascinated by HIMS and regularly tweets about it. For instance, when Mo El-Shanawi was hired as CTO earlier this year, Rob tweeted, "I'd bet 99% of people shorting HIMS have never used it. If they did, they'd see the roadmap of this company so clearly. I bought Nvidia and AMD in 2016, and this seems just as obvious." So we're excited to talk to Rob about why he thinks the opportunity with HIMS really is as obvious as Nvidia. Rob Leclerc, welcome to Him's House.
Thank you, Jonathan. Thank you, Patrick. I've been a fan of you guys for a while here, so it's an amazing community you guys are building.
To kick things off, could you tell us a little bit more about your firm, AgFunder, and then again, why you think the opportunity with HIMS really is as obvious as Nvidia?
Yeah, so just a little bit on our firm. We're a deep tech VC. We have about 300 million assets under management. We invest in AI, robotics. We do some healthcare work. So we touch a lot of things. And so sometimes I use my sort of public markets portfolio to test my thesis in a little faster loop, because venture capital is like 10, 12-year time horizons, but also to really get a better feel for what's going on in sort of public markets and how that pull through is coming. I looked at, you're always looking, I think as a venture capitalist, we don't look for 10% compounding annual opportunities. We're looking for something that we can buy and hold for 10 years, right? That can have a 10x or greater outcome. That's the sort of standard. And so I kind of walk around and spend my time looking for that in public markets. I think about, back in 2016 when I invested in AMD and Nvidia. So my background, did a master's in AI and for robotics, and went to Yale for a PhD in computational biology. And when I was at Yale, I was building a kind of a simulator for simulating gene regulatory networks. And I ran out of compute power really quickly, and then started to look into using Nvidia cards and their new CUDA platform. And my lab wouldn't let me use the resources to buy the equipment. They're like, "We're not letting you buy video game cards on the Yale grant."
It was too expensive for Yale?
No, it wasn't too expensive. They thought I was just going to be playing like Doom all day on it or something like that, right? Or Counter-Strike. And so they shot me down. But I was, it was then that you're like, wow, if you're going to do high performance computing, you're going to do it with these GPU cards, right? And so you have this early experience with something, and you watch it and how it's growing, where the market's going to grow into. And I just sort of had a similar experience with HIMS. As you can tell, I'm a little thinner up top, right? And so I had used.
It looks okay. It looks okay.
Rob. So I'd used HIMS for skincare and trying to fill out my hair, and it was just such a superior experience to my normal experience of going to a doctor, right? Like, for me to go to a doctor, I've got to rush down there, in the morning if I can get my appointment, and I've got to be the first one there. And then I'm waiting in the lobby for 35, 40 minutes. And then I'm waiting in the waiting room. And then the guy comes in, and I have great GP, but he's looking at 1,000 different things that day, right? And so the quality of the knowledge that they have on your specific particular problem or your concern is just not as great. And so you realize that I can do all of this online. Somebody is much more knowledgeable. And then when you overlay AI on top of that, right? So I got some labs done. I try to do annual labs and then baseline them. And now I just throw everything in ChatGPT.
What do you use for the labs, by the way?
So for the labs I had, I was just like, just went in. I asked ChatGPT, I'm like, give me the full set of labs. Here are all the things I'm concerned about. I'm a 52-year-old male. And I went in and I gave him a laundry list of things. Like, here's all the labs I want. He's like, okay, it'll be, another $300 more. And I came back and I had to also get AI to analyze those labs. And you think about it, it's like the traditional way of going down to the doctor, and going in and doing the labs. Like, so many of these labs can just be done, in your house. They can mail you a kit and you can mail it back. There's nothing special about this, right? And so it's just a superior experience, in every possible way. And so, it really does feel like a kind of an Amazon type opportunity where people don't necessarily want to get up and go to and hang out at Walmart. They just want to go online and order something. And so that was sort of my conviction on the company was, oh my God, like this is I guess it was probably a $5 billion market cap company at the time. Right. And so you're thinking, okay, well, what's the possible opportunity size of this given healthcare? So you check the boxes on like 10x, the rule of 40 rule, like LTV to CAC, like all your sort of venture capital sort of your benchmarks and metrics you go through, and you're like, this is incredible. I can't believe I can invest in this as a public market investor. So,
and when was this that you took an interest?
I think I was probably October. You kind of mull on it for a while.
Of 24, Rob?
Yeah.
Okay.
Yeah.
Okay, so we're at like 10, 11 months. I guess like a month after I started Him's House, actually.
Right. Yeah. So I started following you guys, and it was great to have like this sort of crowdsourced community as well. Right. I think it's amazing.
Cool. So you're a tech guy. We want to ask some tech questions that we haven't asked of other guests. It's been a little policy heavy recently. We want to focus a little more on the tech today. And Hims has been focusing on the tech the last, 3 to 4 to 5 months as well. So I want to start with something that Hims investors have been at best cautiously optimistic about and at worst extremely concerned about, which is that the tech leadership at the company now consists of multiple ex-Cruise engineering people. There is CTO Mo El-Shanawi, who is president and CTO at Cruise, now CTO at Hims. There are a couple other AI leaders as well that are also ex-Cruise. The reason that some people are worried is that Cruise as a company sort of crashed and burned following that pedestrian collision and fatality in 2023. Do you know Mo or anyone else on the Hims engineering team, and like any thoughts about those hires and the tech team that Andrew Dudum is assembling over the last 3-4 months?
I mean, I will say, if you're working on robotics and automation, you are some of the best engineers on the planet, right?
And Cruise was a top.
It was a top. We invested in a company, Verdant Robotics. The CEO, I think he came from Cruise. He was at Zoox. Their foundational team is one of the best. This is the best technical team we've ever invested in. I did my master's in AI and robotics, so I'm right dead center in this, in where we invested in. And I'm on the meeting with these guys, and I'm like, oh my God, I have no idea how they're going to solve this problem. And then 3 months later, I'm like, this may be unsolvable. And 3 months later, they're like, yeah, we solved it. So to hire people of that caliber, right? I think is incredible. In Silicon Valley, you never look at then there's lots of reasons companies can fail. There's a million reasons companies can fail, right? And a lot of success ends up being, luck and timing and all of this stuff. What matters is not sort of the outcomes, but the process and the input you put into it, right? And so hiring, excellent, amazing top talent, and they were a magnet for top talent. So that's one. I don't know Mo, but I looked into his background. What is his background? He worked at Amazon. He did robotics, automation. He knows AI. He did a lot of, he was working on safety at Cruise, right? So he's working in a highly regulated environment, right? So if you're thinking about, okay, who are we going to hire as a CTO, right? You need to think about regulations. You need to be thinking about AI. They're going to be thinking about automation, because they're probably thinking about how do we automate fulfillment and take human out of the loop out of all of this stuff. Right. So you're automating some of the labs. So you need somebody who has these sort of that level of technical expertise. You don't necessarily need like, somebody from Stripe or some SaaS guy, right? You need somebody who has a full stack understanding, but of some of the really hard physical stuff that they're going to end up working on as well. So I mean, I don't know him, but like, if I was the CEO of HIMSS, I'm kind of looking for that kind of phenotype when I'm trying to hire somebody. And knowing the Cruise team and people from the Cruise team are wicked smart. So I see that as sort of a plus rather than a minus.
So what you just said about Stripe and SaaS it's like the first time I'd heard that Mo may be involved in fulfillment and manufacturing, which is really interesting and probably a good point. Like there's been disagreement online about whether HIMSS even needs an self-driving car level engineering leadership team.
Right.
Because the company is like, if you look at MedMatch, the AI recommendation system, they're probably fine using the foundational models, GPT, Gemini, at least for the near future. There's some off-the-shelf stuff now, like from Microsoft's AI specific. I think it combines GPT-03 and maybe some fine-tuning. I don't know the details there. But there's some off-the-shelf stuff that performs pretty well. So the question I've seen is like, why go out and hire Mo Elshenawy, robotics automation guru, one of the best minds in the world for solving those real world physical problems using AI?
Yeah, I mean, I really think it comes down to like what's the quality of the athlete rather than hiring for the position, right? And again, robotics and AI is a wicked hard space. You have to be extraordinarily smart to operate in those spaces, right? And so if you're hiring people with those backgrounds, they may just be fundamentally smarter than the next guy who walks in the door, right? And I want wicked smart people who can solve problems. I mean, when you go do a computer science PhD, I mean, you are in some sense just a sort of a generalist. In there, you understand math, you understand like solving and breaking down complex problems, right? So I wouldn't look at the domain expertise as being I wouldn't overly index on that and say like, wait, why do we need driverless cars? It's like, why do we need really smart people who can adapt to regulatory environments, automation, fulfillment, if that's an area that they might be going to. Anytime you're taking humans out of the loop, right? I think you want people who can think in that way.
To what degree is all of this centered on trying to become a tech company in the minds of the public markets? I mean, right now, HIMSS does not sport a Robinhood multiple, right? But they've gone out and hired their first ever chief product officer, a lady from Dirja, a lady who brought the Robinhood Gold program to life. Hiring Mo as CTO is sort of another step in that direction. Is this about wanting to be perceived as a tech company?
I mean, a good CEO is going to, kind of pad the optics as much as they can. I mean, and all else being equal, why wouldn't you? But, can they be? I mean, if you look back at like, I don't know, 1999, people were laughing about Amazon, like this isn't a tech company, right? I mean, the famous Barron's article, right? So you could absolutely make that same argument with HIMSS. And I think you'd look pretty silly in 10 years looking back and saying, okay, well, I guess it was a tech company. And we, I think understand what tech is has evolved a lot, right? I mean, we start off with a slog. We do things manually. This is sort of the engineer's mindset. You go in, you figure the process out, and then piece by piece you figure out, okay, how do we just make this better? How do we automate this? How do we put an algorithm around this? How do we use a robot in this instance, right? And just it's a little, these little tiny grinds, and then you build up to something big. I think if you look at like sort of what a 10-year vision would look like, I mean, I could literally imagine a world where I don't go to a general practitioner anymore. I just go. I like HIMSS offers an insurance product for me that I see all my specialists on there. If I do need to be somewhere physical, they may have a couple physical locations, or maybe you just go to CVS, and CVS has like a little mini lab that you can go and get some vitals done, and then it gets submitted over. There's no real good reason to be physically somewhere for 80% of your visits, right? Then you get into even the specialists, right? That a lot of this can be handled, all of the screening analysis can be handled with AI. I just think we've got a super bloated healthcare system that's really inefficient, that's very expensive, and that HIMSS could come in and solve massive quantities of this problem with technology. So like, I don't mind taking the slog. It's like directionally, are we going where we want to be?
Great. Bayside, do you have any follow-up questions on the tech? I know you have a few questions around the verticals and other specific stuff like that.
Yeah, I appreciate that. I will get to those questions. For me, just the quick follow-up is this. I think you would know. You mentioned sort of the .com era and Amazon back in the day and how people misjudged that particular company. But there was an implosion in those days in 2000, 2001. And even Amazon was affected by it, at least in terms of the markets. Some people are making the comparison to today that the AI focus has been a bubble similar to what's been true back in the day, that some folks at the top of the eco chain, if you want to call it that, like the Nvidias of the world and others, and then maybe some of the cloud providers are doing well. But if you go further down from there, that a lot of the startups and others are burning through a lot of cash, and it looks a lot to some people like what 1999, 2000 might have looked like back in the day. So I guess my big question is, how much truth is there to any of that, or are you bullish and that you don't see a comparison? And then I think you almost answered this question, but just to give you another chance, what effect would that have on him specifically, since it is presumably downstream from some of those folks who are making money?
Right. So there's a great book that influences a lot of VCs. Carlotta Perez, I think it's Technological Innovation of Financial Capital, and she talks about these boom and bust cycles. I mean, we can go back to the tulip bubble, but if you talk about technology specifically, with electricity, the steam engine, the early computer, .com, and it was written around the .com period, right? I have no doubt that we will have a bubble here, right? And what a bubble means is we end up over investing in capacity, right? Before we get all of the sales, some of those investors really coming in at the end, overbuilding, they lose their money. There is a point now where that technology is still diffusing out, though, and then we have the crest, and we also see it in the sort of the Gartner hype cycle, right? There's the trough of disillusion, like there's the peak, and then there's the trough of disillusionment, and then there's the value. So I think it's also important to think about like what time horizon. If you're trading on a 3 month, 6 month, even 18 2-year time horizon, right? Then maybe you're really concerned about, okay, where am I in the trough of disillusionment? But if you're thinking long-term secular trends, right? I mean, there's no point, like if you invested in Amazon at the top of the market and held to today, you'd be fine. Right, right. You would have beat the S&P.
Be better than fine, probably.
Right, you would have massively beat. So it's like the question is, it's like what question are we asking? It's like how to gamble and trade this really well, better than anybody else. So yes, we like absolutely will. Whether we're in 97 or we're in 99, I think is a big open question. And I think that'll depend on where the models are progressing, right? Are we asymptoting, right? If we can continue at least on a linear path, then I think we can still go. So I'm watching that sort of quite closely. And at some point, you're looking at some of this data center spend. You're like, are they going to run out of money? Like, where are they going to come up with the next $1 trillion next year? Like, it's not like there's endless money to put in to data centers. So absolutely, there will be a bubble. Absolutely, we're in a bubble, but that's just part of like markets, right? And I think if there's no markets to get bubbly about, I think that's a bigger problem. Like, it's just like, oh shit, so we're just in a permanent state of stagnation. There's nothing to get excited about.
This is quite fun.
Yeah. So, and this is frankly, I think one of the question is this time different? It won't be. But it will be different in many ways as well. We've never seen anything like AI before, and we can really imagine how far it could go. What we tend to do is over imagine in that short term what it can do, and then our imagination falls short on the longer term on what it can do. So it'll disappoint us in the short term, and then in 10 or 15 years we'll be like, oh wow, I can't believe that AI can did all this or can do all of this, and I would have never imagined that 15 years ago.
All right, I am going to shift to a few questions that are one is sort of backward looking, one is a little bit more present day, and the last one is more forward looking, all related to HIMSS. So we'll start by looking at the backward. So it's beginning to look to some like at least some of the HIMSS legacy categories, like for example, ED, are starting to slow down. The online news site Sherwood recently did a story on another ED company called Blue Chew. In it, they said, they quoted the Blue Chew folks as saying the category is, quote, definitely approaching the top of the S curve because it's not parabolic like it was up until a couple of years ago. Does the potential slowdown in some of the older categories like ED, along with the really deep competition that exists in those legacy categories, worry you at all? In other words, should we be worried about the slowing growth in the core and the compressed margins that are there?
I say no for two reasons. One is usually in the history of like great technology companies, you get these S curves, but over a long period of time, you get sort of this nice exponential because you ride S curve after S curve after S curve. So a great CEO and a great company, and that also means you're in a great market, right, is open-ended enough that it offers you new opportunity over time, right? And so
that will speak to my next questions,
right? And the hardest part usually in venture is well, what's our wedge market? Like, how do we establish ourselves and not boil the ocean, right? So they start with boner pills, right? And then they do some hair loss and they do some skincare, and then they're going to do the weight loss came along, and that was something that they could work on, and so all of these are little S curves, but you start. What really matters is, can you capture somebody's attention, hold onto them, right, as a patient, and then build the offering. So that they can do that. I mean, I think it's interesting because if somebody wants to start a HIMSS today, and there are there's Roe, there's Henry's, and there's others that are trying to start up. They're going to be battling for customer acquisition costs, right? And I think HIMSS is probably $600 or $700 CAC with probably a 2 to 3 year payback period, a really nice 3-to-1 LTV. They've got great brand name. As more players come into the market, CAC for everybody raises. And at some point, it becomes too expensive for anybody else to acquire customers efficiently, right? But they've already got a large base. That base, and they'll have it because of that large base. It'll be much more efficient, always be much more efficient for them to capture that marginal customer. So what's important, right, is as these new offerings come along, that can they expand their brand? Can they expand their subscriber base? And with that brand, can they outcompete others? So some of that margin erosion and all of that is competition. And that's fine. We expect competition, but is that a battle they're going to keep fighting, or is somebody coming in with a market trying to buy into the market, realizing they don't have the efficiency, and then falling to the wayside? And so my bet is that HIM's CAC is lower than anybody else in the industry by 20%, 30%, and it will only get cheaper, relatively cheaper. So that makes them fundamentally more and more competitive. So they can take margin hit to stay competitive at any point in time. And so I have no worries about that at all. And that's just sort of just, how we see, a good opportunity the mature. It's like this sort of part for the course.
Jonathan, that sounds like an answer that I was trying to give you over the weekend.
Yeah, which is just to say it's a short run concern, but if you have a long run venture like mindset, this is not a problem.
Right.
All right. Well, let's look to some of the other S curves that might be current and in the future. So let's start with I guess something that's a little bit more present day. HIM's recently announced the acquisition of ZAVA, which will help pave the way for international expansion. What do you think about international expansion? Is it a distraction, or could this be a big business for HIM's down the line? Let's start there.
Right. I mean, it certainly. I don't know enough about the European regulatory market, other than to know that generally I hate European regulations. So that would be a concern for me. It is a bit of a concern on the one hand, because managing a team over there means you have to spend time there. You got to get on planes. You got to, completely different regulatory environment. Dealing with the EU is counterintuitive in many ways. So it could be that it's more like an Airbnb, where Airbnb goes to Europe and they had to do it early, and they had Rocket Lab, standing up their competitor, but Airbnb was able to go in early into that market and outcompete. So we could have a situation like that. And it's probably worth the gamble, right? So is it a concern? Yes. If they're having problems with it, it's what they do with it after, right? If it's becoming a distraction, they should probably kill it. But if it's it could be a great outcome for them. So I think it's going to be how they deal with it, with the success or failure of it, that it determines what if this was a good acquisition, because they can make it, and if it's not working, they could spin it out and sell it to somebody else. And I think there's sort of no harm, no foul at that point. It's the situation where it's bleeding them out. They're having lots of problems, like syncing that up with their US business. It's like two completely different businesses. There's no sort of sharing of administrative costs and all of this stuff. So it could be that just like, look, we can share a whole bunch of these costs, and it's just a marginal, addition to our cost to add that business. So it's hard to say at this point.
Hard to say. Fair answer. This one might seem a little unrelated, but timing wise it was. And since given your background, you probably can give a quick answer on this one. Around the time they announced that acquisition, they also announced a new funding round, which pulled in around $1 billion or something like that. What do you think about that?
Yeah, I mean, I think I encourage, so if this could be a private company still, right? From, there's private companies that are 5, 10, 20, $30 billion. So this could be very well VC backed. And in VC world, we're like, go raise a bunch of capital, get yourself a moat, right? Raise when the market is good, right? We're not worried about sort of short-term profitability and taking on some extra capital, especially when the terms are good. I mean, they bought what was it? What was the strike price, like 70 that was convert, and then they got
just over 70, yeah.
Yeah, and then they hedged it out with some cap calls at like 89 or something like that, right? So to minimize dilution. So it's like a 5% dilution. I mean, to say, hey, you need to now grow your company without taking on any external capital is silly when the magnitude of the opportunity is big, right?
And 0% interest on this money as well.
Right. So it's basically like what we'd classify as like a safe investment. It's SAFE, sorry, not the vernacular, VC vernacular. But so I mean, this is great. They've got a bigger moat than anybody else. They can do a battle of attrition, right? So I'm not concerned. I mean, I would be concerned if they had only a couple $100 million in the bank and they need to be a little more careful about managing their cash. So I think they're in a good spot.
Bayside,
you're vibrating or something.
Yeah, no, I apologize for that. That's a phone that's I can't get to. Should be done. Okay, my last question for you, and then I'll turn it back to Jonathan. This one in some ways circles back to something we were talking about earlier, but I want to get a little detail. This one's more forward looking. So HIMSS looks like any day now it's getting ready to launch a new diagnostics capability. You recently tweeted that, quote, HIMSS plus home and diagnostic centers could replace 99% of visits to a primary physician with better care while saving the American healthcare system trillions. That sounds pretty optimistic. I think it's safe to say you think that that's an exciting opportunity. You spoke about it a little bit earlier, but I'd love to build on that. And specifically, let's go beyond it. What do you think about wearables or some of the other data-oriented devices out there? Do you think, and then coupling that potentially with AI, tell us a little bit more about what you think the opportunity looks like and who might HIMSS partner with, if anyone.
Right. So I don't have an Oura ring, but I have an 8 Sleep. So,
how is it?
It's fantastic. I mean, just buy it. You can return it if you don't like it. So are they? You should sell them on a sponsorship for this.
I've been trying to get them as a sponsor. Anyway, here they are. 8 Sleep. Okay, go on, Rob.
Right. So it's great. It tracks your sleep score. It gives you a nightly sleep score, REM sleep, deep sleep, heart rate variability, heart rate, breathing rate. How much you're snoring, and then you can sort of backload all of that and see, what am I doing? What am I eating? What's my sleep patterns that are driving all of this, right? I go get labs like now annually, and I put everything into ChatGPT for like a full analysis, right? So, and I'm probably in a sort of an early adopter with this, right? Because I have to do a lot of the manual work, but this technology will be quite ubiquitous in 5 or 10 years, and it may even affect your insurance, right? So there could be great reasons why that everybody has all of this sort of wearable and tracking data, and it can get ahead of health concerns a lot easier. And when you can measure it, right, you can do something about it. So I think there's obviously an opportunity for them to partner with people like 8 Sleep, people like Oura, on the home diagnostics. I think we can go, way deeper than we currently are. I mean, if you go to your GP and you ask for, a set of labs, they'll be like, okay, but you can, and it can be expensive to get some other labs, but you have, the MRI scanners now, like you can spend, I don't know, $3 or $4 grand to go and do a full body, cancer scans and everything. Right. So the ability to get data on the human body at a resolution we've never seen before, right? Use AI to do this analysis. And they can partner with lots of people to do this, and then they have the ability to write the prescriptions and make the recommendation for whatever therapy or that you may need. So it seems just plain obvious to me from that like what they will do. It's just a matter of bandwidth, technological readiness, and how available some of these technologies are in the market, right? So if the user base is just too small today, it might not be too small in 3 to 5 years.
Jonathan.
I love the analogy that you mentioned earlier, where one S-curve may be asymptoting, but it's HIMSS's job going forward as something like a venture-backed business to try to stack some S-curves. And so I want to ask you about future categories and which might be most compelling to you in terms of presenting possible future S-curves. HIMSS has mentioned that they will get into testosterone and hormone replacement therapy. Yep. They bought a peptide facility earlier this year. We just had a peptides episode. And as you probably know, peptides are going wild on Twitter, and specifically tech Twitter and certain corners of TikTok and elsewhere. Longevity supplements and sleep, which you sort of mentioned around 8 sleep. Do you have any thoughts on those future trends in which might present future S-curves?
I think they're all available, right? I mean, if you just look at your healthcare system is your ultimate sort of market and reference market. So it really becomes a question of which product line do you start to go after next, which is has the greatest bang for the buck, which has the sort of the lowest regulatory hurdles, which has most market pull through demand, what is not being met in the current healthcare system very well, and then they can push stuff off to later. But all of this is going to add to their subscriber base, and at some point, again, you get to a critical mass where why do I need to go to a GP for anything, right? Like anything, and so I think the ultimate jump is for them to move probably beyond just generics, right? And things that are to actual prescribed therapeutics, right? And working with the pharmaceutical companies at some point, and maybe even working with clinical trials, right? They're going to have a ton of data on people and their conditions, and hopefully more, and again, all in large, really well curated databases. And so to get ahead of things and help people get the treatments that can be most beneficial to them. So there's going to be lots of clinical trials for new types of drugs that may be interesting to some of these people as well. So I just think it's a question of what market do you go after next? Like what's the order of operations really? And I mean, all of those sound great, right? And a lot of them are not being met. I think there's one, there's being embarrassed, about going to a doctor about certain conditions. Sometimes maybe you're going to a doctor and you feel like you're asking permission, right? You're not like you feel like you're a child asking a parent for something when you're talking to your doctor. I think that relationship's probably more peer-like, with HIMSS than your traditional GP. So I think there's going to be lots of great opportunities. I don't really have an opinion on which is the next best market. I think they've done that analysis. I think I think they've nailed some of the obvious ones, right? Like testosterone replacement theory. There's going to be trends and things that people are excited about, and you really also need the molecules that are going to matter in this.
We want to fit in one policy question because you did weigh in about that, and then we'll bring it home. Anyway, back to you, Bayside, and then I'll.
Sure. So I'm kind of the policy person of the two of us, so I guess I'll do this one. We asked some version of this question of virtually all the guests, and given the time limitations, we want to ask you some other things. We'll keep this one short, to just couple minutes if we can. So you've said a few things about the regulatory situation around compounded GLP-1s. There's a few different things that could potentially be negatives there. One is possible action by the FDA or the FTC or just HHS or the administration in general, things around most favored nation perhaps, or even Congress taking action. And on the flip side, there's also Novo that's been out there. And here I'll quote one of the tweets that you wrote. You said, if Novo wanted to take out HIMSS, they'd target a less well-funded company that's following the same protocol as HIMSS. Basically, you say because that hasn't happened yet, this suggests that Novo doesn't think they'd win a case. So either between what Novo's doing or not doing, and or some of the things that might be coming up from the federal government, kind of what's your take on that in just a couple of minutes?
Right. So you've got the FDA, right, and then you've got sort of the patent office, and it seems like Novo has been focused on trying to get the FDA to shut them down, and that's sort of the easy route because they don't. Seems like they are worried about any challenges on their patents, and from what we've seen so far, the FDA. What does the FDA care about? Right. It's safety and efficacy, right? And they've got the compounding rule that's set out. Novo could, as I understand it, produce a vial tomorrow, right? Which would shut down 503A compounding because you're allowed to do 503A compounding if there is not an alternative that they can use, right? And the problem is, it's like, okay, well, let's say I want to inject 5 units of semaglutide, or 3 units, but the minimum pen size is 5 units. Well, then I can do that. Well, they could get around that by producing a vial and putting it out on the market. Has some downstream effects on, probably for 6 to 8 months when the semaglutide patent expires, but that seems like a bit of a straw man argument. So they could kind of come in and do that, but they haven't. They've kind of tried to get the FDA to shut this down, and the FDA is basically saying, "Look, it's not our problem, right? Here's the rules." And again, they could do something about it, but they're not doing it. So and
to be clear, you're saying they could roll out more doses.
They could all they would need to do is produce a vial, right?
Which
because a
gives you
vial
flexibility
basically
to do
gives
any
you
dose,
any
right?
dose that you need. Because what they can do today is say, look, we can't tolerate the 5 unit pen, and so we want to start off everybody with a 3 unit injection, but you don't do a 3 unit pen, and so what we're going to do here is we're going to give you the vial, and that is the loophole, right? But if Novo came out and said, okay, well, that's not a problem, we've got the vial. Now you cannot rely on 503A because there's no alternative to the pen today, right? But if there was an alternative because there was a vial that gave you an open-ended dosage, they wouldn't be able to sell that, right? Do you understand?
Yeah.
Yeah. So it's interesting that they're holding off on that. It could have some downstream effects on their patent. It'll make it easier when the patent expires for the generic to just flip over. But it seems like that would be save them 6 to 8 months, or give them like 6 to 8 months of sort of patent extension, really. But it's pretty de minimis. So, right. Yeah. So I mean, I think it's interesting. From they're not going after the patent at all, or they at least haven't, which suggests, and there's some precedent that says that they may have some trouble doing that. They're still making, they made $25 billion last year. They'll probably make to $28 billion this year on semaglutide, right? And so they're like, okay, are we willing to accept some loss of $3-4 billion, and maybe even half of that are people who just say, look, it's just too expensive, right? I'm not gonna buy it at $8.99 or whatever it is. So there, in some sense, there were never really customers in the first place, potential customers in the first place, and anybody who has insurance and does need it can get it through insurance. So there's it could be that they just let this go for as long as they need.
That's one possibility. Jonathan.
So I wanted to ask about the public markets broadly, just to zoom out and away from HIMSS for a moment. You tweeted about getting companies to the public markets earlier. You mentioned HIMSS, ASTS, Rocket Lab as three that have performed extremely well in the public markets. Small caps, heavy retail interest, all trading above their SPAC level openings and highs. Your idea is maybe a deep capital gains discount for investors and founders for companies that go public within 5 years of raising $50 million. Can you say a little bit more about that?
Yeah. So I think so. One of the problems is that just everything is being held up in private markets for way too long, and this is a problem in venture capital. We have 10-year fund lives with the 2 optional year extensions, and now people are talking about 15-year fund lives. Right, you got Databricks is $100 billion company. It's bigger than Snowflake right now, and I mean, I think it's unhealthy for companies and the economy and for innovation and for investors to have incentives in place that sort of permit this. And so I'd like to see incentives shifted to get companies to try to go public on a much earlier basis. And it might not happen for every company. It might not be something that would be applicable for HIMSS. Maybe and so I sort of think it may be more applicable for, say, deep tech companies. But there was generational wealth made for investors in public markets. With Amazon going public when it did, and public market investors have enjoyed, Amazon and Netflix and Google for a couple decades now. To dump it onto retail after their trillion-dollar companies and now growing at 5%, it seems like a little bit of an injustice, right? Now the SPACs got a lot of flack, but to be honest, a lot of them actually are doing quite well now, right? And they follow a bit of a venture capital sort of path. Like if people are expecting your earliest public market companies to be highly profitable, to never raise another round of capital, they're just sort of, I think, misinformed about that category of company. I think we look at Series D, Series E companies as fast growing. Will they need more rounds of capital? Yes. Can they grow bigger? Yes, but they're still amazing opportunities, and so it drives me nuts that we're stuck in this. And so I've thought about, like, how can we incentivize that, and maybe offering investors bonus depreciation on these investments, figuring out some way to get investors to invest earlier in some of these companies, and then the incentives as well to get these companies out into the market earlier, right? Because we're just not doing enough. I mean, we used to IPO companies, within 4 years during the .com and prior to that, and now it's a long time. So HIMSS is actually a pretty young company, right? It was founded in 2017.
8 years old, yeah.
Right. Airbnb, it took them 12 years to go public. Right. So I think Uber was similar, right? So these were already
Figma, very similar. Yeah.
Right. So I just think we need to be thinking a lot harder about the incentives. And it could be a tax incentives. It could be a sort of a dual market structure where you don't have the same we reduce some of the compliance overhead for early stage public companies, also for investors, right? So allow venture capitalists to invest in public companies. Right now, you have a venture capital exemption where you really can't invest in public market companies. But maybe if the companies were below a $10 or $20 billion market cap, allowing them to invest their venture capital funds into those, which would encourage them to, hey, we're not going to lose our venture capital by allowing these companies to go public earlier. So
quick thoughts on Robinhood's plan to tokenize private companies.
Interesting. Right. Interesting. I just don't know how that's going to play out. I'm glad they're trying. I love experiments. I think it's, again, it could be tokenization of companies, people raising off ICOs. Like there's the Believe app, my friend Ben Pasternak started, that maybe people start natively tokenized, and by then be natively tokenized, you're natively tradable, right? As opposed to having to wait for some IPO event where you have a massive change in liquidity.
All right. Let's bring it back to HIMSS to close. I want to close with some discussion around valuation and price targets. You've said a couple times that you think about this as a longer run bet, like 5 years, 10 years. And so you're less focused on the price gyrations over probably a 3 or 6 month time horizon. But what do you think the fair value is today? How are you thinking about it? Is it a DCF? Is it multiples analysis? And then as we zoom out like 1 year or 2 years, where do you think we could go?
Yeah, I mean, it's really hard for me to talk about like fair pricing today, because fair pricing today is like whatever somebody will pay for it. My projection from this is, what would HIMSS look like in 5 to 10 years? And I generally work backwards from like market cap, think about sort of a comparable. Can it be $1 trillion company? Can it be a $500 billion company? And if it can, what would that imply? Maybe there's a little bit of dilution there. What would that imply for a multiple that I can get today? Now, because in today's multiple, you also have to figure in what the risk is, right? So they could have a patent lawsuit against them. It could really hamper their ability to bring in cash, which could hamper their growth rate. So, it's really hard to sort of peg that. So I'm looking at I think there's a high probability that I can 10, 20, or 30x my investment over a 10-year period. But I also think there's, a good chance, and that might be 50-50, that I might not lose all my money, but I could probably lose 70%. I'm sort of up over 2x now. So if I went back, maybe I'm down 20% from my initial cost basis, right? But that's venture capital. We go in typically knowing that 70% of our investments are going to go to zero. And so, we're very comfortable seeing an investment go to zero, as long as your winning investments can 10, 20, 30x. And if you have enough of those in a portfolio, you can sleep well at night. So I have a higher risk appetite, knowing that the reward can be, exponentially greater than, the finite money that I can lose. So I bought a little bit more as it sort of dipped down almost to 40. But I've got a decent sized position now. And because it sort of grew, and it was already a decent sized position, I'm like, okay, rationally, I should probably, not be so concentrated. But I think it's a decent price at 40.
Great. Yeah. So as we're recording this, we're at 49.80, market cap of 11 billion. You think hundreds of billions of market cap is reasonable? It sounded like, based on the
it's over the time horizon, right?
Over the 5 to 10 year.
Yeah, and that's new product lines. That's maybe you're meeting with an AI doctor. They're doing AI analysis. You're getting full sets of labs sent to you. You can speak to specialists. They're doing a ton of revenue at that point. And so it's a 20 million subscribers. There's a much different company than it is today.
Sure. Good deal. We'll be on the lookout for 10, 20, 30x over the coming years.
Right. I think it's a patience game. think it's a
I
patient
think there's a few members of the audience who are very happy to hear what you just said.
Sure. Rob Leclerc, thank you so much for being a part of Him's House.
Great. Thank you.